Hello, my fantastic, awesome, wonderful, super cool Econ 445 students. Hope everybody's doing great. What's going on in the world today? It's Monday. I know the day of the week this time, so we're doing pretty good. I needed to motivate myself to do all this recording alone, so I ordered pizza, and it's fantastic. All right, let's talk about where we are in this course so far. So like you probably saw in the emails, I canceled homework 9 and just gave everybody 100s because I need to catch up on grading. All of you are working on your final papers. There was a lot of things due at the same time and it seemed unnecessary at this point. I know if you understand this information or not. On that note, if you have not gotten information back from me related to your policy brief, that's a problem. You should hit me up because every single policy brief that I had the rough draft on at this point, I have responded to with comments to your email. If you do not have that email, there is a problem. Please contact me. Let me know. Something might have been lost in translation. Okay. Then when it comes to deadlines, let's just go ahead. Let's jump in. Let's look at deadlines real fast. So let's share the screen. Okay, it's way down at the bottom. Well, we're going to get to this in a minute. We're doing the taxation of business income today, which will actually be kind of cool. That one's kind of fun. It's a long lecture, but it's a fun lecture. Let's talk about the syllabus real fast. So notice that we have a couple things coming up, right? We're right here, 420. We're talking about state level corporate taxation. Ooh, we're going to be talking about that a little bit. Next time, we're going to be talking about some of the politics that are related to tax reform. Outside, and then after that we start talking about like looking forward, what are a lot of tax changes that might happen. Honestly, this one's probably going to be pretty heavy in the how is COVID-19 going to affect taxes, how are we going to have to change the structure of the world to deal with this. So that'll be a pretty cool lecture. On 429, this is when your policy brief number 2 is due, right? 429, boom. Whatever policy brief I have given you back, I gave you the comments on your rough drafts. You need to finalize them up. They need to get to me by midnight on 429. Okay, so do that. It's a Wednesday. It's also going to be a review day that day. So what I'm going to do is I'm going to take all the homeworks that we've done so far. I'm going to go through, I'm going to give you the answers to all the homeworks and work through them, and then I'm going to give you test hints. So there we go. Now, what are we going to do about your final exam? So our final exam was set by the registrar on May 4th, but it was going to be from 12 to 1:40. I know each of you have access to laptops at different times, right? Like some of you might have kids that need to use the laptop. Some of you might be sharing it with other people. So what I'm going to do is I'm going to leave the test open for the entire day, right? So you're going to have 1 hour and 40 minutes to complete the test. Whenever you first open up the test on Blackboard, you must finish it in 1 hour and 40 minutes. If you leave, if you decide to log out, you're done. That's it. You've submitted, it's done. Right? So you don't have the option to leave and come back. It will have to be finished in one sitting. You have 1 hour and 40 minutes to do it, but you can start it at any point in the day as long as it is completed by midnight on May 4th. So I'm going to open it up at midnight. It's going to close at midnight. So you need to get it done within that window, May 4th. May the 4th be with you. Please remember this. Okay? So yeah. I think we're good. We talked about the final exam. We talked about the review day. We talked about cool. Okay, let's transfer into some interesting stuff. Or at least I think it's kind of interesting because, I mean, you've probably heard a lot on the news about what are we doing with taxes when it comes to businesses? What happens when businesses like operate overseas? Is that good? Is that bad? Who knows? So we're going to talk a little bit about that today when we talk about taxation of business-related income. All right, so let's motivate this. Let's motivate this. Something that you might remember in your time. This actually happened while most of y'all were enrolled in this school. So on December 22nd, 2017, flashback. All that time ago, back when we could go to movie theaters and to Walmart without panicking, and life was beautiful, and I could still go get ice cream whenever I wanted to. It was a good time. It's a good time. We thought that was going to be the worst year ever. Yeah. Do y'all realize 4 months ago, Australia being on fire was still a thing? Like that was the defining feature of 2020? Anyways, okay. December 22nd, 2017. Donald Trump signed into law the largest overhaul that we've seen in the U.S. corporate tax system in 3 decades, right? Before that, the corporate tax rate was like 35%, and it ended up reducing it all the way down to 21%, which is a huge drop in the corporate tax rates. What we did in this situation is we moved from a global tax-based system, which very few countries still use, to a territorial tax-based system, where firms are only taxed on profits earned in the US. So we're going to talk about that in a little bit when I give you the definition in between different types of tax systems. This also gave a lot of allotment for unincorporated businesses. So not everything is a corporation. Some people decide to remain unincorporated. So unincorporated business owners were also given large tax breaks to try to equal this out. Now notice when the tax rate goes from 35 to 21%, that's less money coming in, right? The bill reduced projected corporate tax revenues over the next 10 years, so in between 2018 to 2028, by $644 billion. And that was the number that they predicted at the time. That number did not include every business in the United States like having to be on limited or closed capacity for long periods of time, right? So this number is actually probably much larger now. So we had this tax cut that went in. Now, there were a lot of arguments that surrounded this. Some people thought it was great. It was going to encourage new businesses. We were going to be competitive. Some people were like, maybe not. Maybe this isn't necessarily good because this is going to reduce revenue that we can use for other things. So many people viewed the relatively high U.S. corporate tax rate that we did have at 35% as kind of a significant barrier for U.S. businesses. This might be why some businesses decide that they're going to set up offices in India, or why Apple and Facebook both are located in Ireland for a lot of the time, right? They believe that the new bill would increase competitiveness of U.S. companies abroad and domestically in some cases, of why you might be more likely to employ like workers here, right? Other people pointed out that, okay, this is cool that we raised the tax rate, but we were taxing statutorily these people 35%. They technically were supposed to pay 35%, but they've had loopholes for years. The effective tax rates of these companies are really like 24%. They already weren't paying 35%. Are we going to let this go down more? So some opponents believe that it was unlikely that the movement to this territorial tax system is going to lead to more U.S. jobs. So people who supported it were like, yeah, this is cool. U.S. jobs are going to happen because now people are going to want to be more competitive and we're going to have more U.S. companies. And the other people were like, they were already not really paying those taxes anyways. I don't think it's going to matter. And then both sides of those arguments might have some sort of effect, right? They might be true to some extent. So what even are corporations? Why do we tax corporations, right? So corporations just mean you've decided that you're not going to act as a sole proprietorship, a partnership, limited liability corporation. Well, I guess technically that one can be considered incorporated, but you've decided to incorporate. Let this company exist as its own legal entity, so that it can have shareholders, it can have investors, it can make decisions. In the corporate sector, most production occurs in firms owned by many, many shareholders, right? If I'm unincorporated and I have Alicia's Pizza Palace, that's great. I'm an owner, this is my firm, I'm doing the thing. If I decided to incorporate, I could get shareholders or stockholders. I could have multiple people who are investing into my business. I could have bonds taken out. It's really interesting. We can end up having people who purchase ownership or stakes in the company so that I'm able to grow. So Alicia's Pizza Palace isn't just one small place in Edwardsville, right? It could be everywhere. So having many shareholders kind of spreads the risk of ownership, right? If there's lots of people I have to answer to, then we're not just listening to my bad decisions. There's potentially thousands of people who can be like, no, that's a bad idea. We're not happy with that. You're not going to invest your money that way. It kind of spreads some of this risk of ownership. Now, we do have two types of corporations that we're going to talk about. First is S Corps, and the other one's C Corps. So I just call them S Corps and C Corps because that's what we always talk about in the literature. Like, that's how we denote it. But if you want to use the whole thing, go right ahead. S Corps generate income that's treated like personal income. So this is a lot of the time smaller companies. They make money, and then the owners and shareholders and stuff, they get the money, and this income is treated like personal income. Then we have C Corps. These are your Apple, your Google, your Big Lots, giant corporations that generate income, and this income is taxed under corporate income taxes, right? So let's think about what it means to own something versus what it means to control something. Where is the, haha, hold on, give me 1 second. So owners of large corporations rarely control them, right? The person that owns Wendy's isn't making all the decisions for Wendy's. The person that owns Apple isn't making every single decision and the nuances and the parts of Apple. Owners of large corporations rarely control them because even if they do have a say in the decision-making process, they still have shareholders they have to answer to and like make happy, right? So this creates an agency problem. And remember, all the way back from quite a few chapters ago when we were in the expenditure line, we were talking about the fact that agency problems are just misalignments of interest in between owners and managers, right? I might own Alicia's Pizza Palace, but like, I'm rich. Okay, in this hypothetical situation, I'm not in the real world. Let's say in this hypothetical situation where I am a pizza monger, I'm rich and things are great. Well, then I'm gonna go on vacation to Italy or something, assuming that I could take a plane there. Go check out the dolphins that are in the canals in Venice. Well, my interest is that the firm continues to make money and they produce all the good things and they make efficient, cost-saving decisions to run well. Well, that as an owner is not necessarily the same idea as a manager, right? Let's say I was instead the manager of Alicia's Pizza Palace. I might want to be like, okay, let's buy a jet so I can fly around to all my meetings. Maybe instead I'm going to set up a really good golden parachute. So if I do happen to leave, I have a really great fallback plan. Maybe I'm going to focus on these sorts of things that impact me specifically and not necessarily in the best interest of what the owner wants me to do, right? Detecting and preventing these sort of mismatches in this alignment is really difficult when managers end up controlling all the accounts. So what exactly is the way that we finance firms? There's three main ways that a company can make money, right? Okay, so we have debt financing. You've probably heard about that a lot. So a lot of the time we're like, oh, how much debt is this company taking? We're talking about that a lot right now, considering a lot of the bailout is structured as loans, right? They're low interest short-term loans to be able to help people maintain payroll, but there's still some sort of debt financing, right? Debt financing is the raising of funds. The way you do this is typically from borrowing from lenders or you're going to sell bonds. So these are going to be people that you have to pay back that you're essentially borrowing money from for a short period of time to be able to do something. Bonds are just promises by a corporation to make periodic interest payments. Okay, so you give me $2 million for Alicia's Pizza Emporium Palace thing, and I agree that, okay, I'm going to make you a payment of 10% of that plus a 1% interest every few months, right? These are some sort of agreements that we've made that have some sort of repayment schedule to them, that have some sort of interest tied to them. Bonds are just you're putting up all the money up front and you're not necessarily always a bank, right? So we have this debt financing. This is one way that companies can end up financing themselves. We also have equity financing. We see this a lot with corporations. This is when they make money by selling shares of their firm. They say, okay, we need some money because we want to make more pizza stores, and let's get shareholders. Okay, we're going to have 10,000 pieces of stock, and we're going to give out all these 10,000 pieces of stock. We're going to sell them for like, I don't know, $50. And then after that, they trade amongst themselves. We see things happen in the stock market. Things go up, things go down. But we're gonna sell these, and we're gonna do this so that we can have equity in our firm. This is not the same as a loan. Yes, I do have to pay it back if they decide to call it, but there's no set day I have to pay them back. We're not planning for me to only have this money for 2 years and then I repay it later, right? This is money that's going in to help build the firm. This is equity. But with equity also comes ownership. So maybe my stockholders that have 10,000 pieces of stock in my company, well, now I need to answer to them because they own some of these assets. They've invested the money. They've been here for along the way. They're on the road. So I'm going to do things that make them happy. I might pay dividends. I might create new pizza places where my shareholders are that they'll be happy about and try to stay really profitable because they're going to care if I'm profitable. And I have a responsibility to respond to them. So we got debt financing, equity financing, and then retained earnings. So what's retained earnings? So I'm a corporation. I'm making money. There's going to be some net profit. With that net profit, I can do a few things. I can pay dividends to stockholders so that they get a bonus and then they're really happy. Sometimes we do that. They tend to like that. Or one thing that we could do is we could just keep it. We could retain the earnings. We're not going to use it to pay off the debts. We're not necessarily going to use it to pay our equity holders. Instead, we're going to put it like in a rainy day fund in case a pandemic happens or something like that. So these retained earnings, if I'm not paying them out to debt and equity and I'm retaining them, that means that I'm going to have to pay some taxes on those retained earnings, right? So investors who buy shares in companies can be rewarded in a couple of different ways. Notice I just said the word dividend a bunch of times and you're like, what the heck's a dividend? A dividend is just some sort of periodic payment that investors receive from a company per share. So let's say that I have 10,000 shares in my Pizza Palace. Well, maybe we had a really, really good quarter. Best quarter ever. We're so happy with this quarter. I've made millions and millions more than I expected. Well, maybe I decide to go to each one of these shareholders and I say, okay, for each share you have, I'm going to give you a 50-cent little bonus check. This is a dividend. This is profits that I'm making in that I'm deciding to give some of them to my shareholders. Now they're going to have to pay taxes on that, but this is money that I'm going to give them. It's nice. You do that. When you do that, stockholders tend to really, really like you, so then they keep investing with you, right? They love those sorts of things. The other thing that they can do is capital gains. So if I bought shares of Apple back when they were $10 a long, long, long time ago, and then I sell it off when they're $600, well, that $10, I don't have to pay taxes on that, right? That's money I already paid taxes for. That's money that I invested in. What about the other $590 that I just made? This is all new money to me. This is all new, essentially some form of income for me, right? We're going to call this capital gains. Now, you've probably heard the term capital gains taxes. That means for every additional dollar that I'm making on top of my initial amount, so that initial $10 up to $600, that $590, that this capital gain, the money that I'm making on my money, I'm going to have to pay a portion of taxes for. So what happens? This is a nice graph, so you're understanding what the heck I'm talking about, right? Let's say that there's a firm. This firm needs to finance an investment. Alicia's Pizza Emporium Palace really wants a new location in St. Louis. That would just be the coolest because people don't want to drive all the way to Edwardsville. Well, there's a couple things that I can do to raise that money, right? First, I can use retained earnings. I could have not paid off debt and not paid off equity, and a lot of the earnings that I made, I could have put them into a bank account somewhere, and I'm using the money in that bank account to pay for my new location. Okay, cool, super easy, one way, done. All right, but let's say like maybe building that new location is really expensive. Maybe I just don't have hundreds of thousands of dollars sitting around in a bank account when I am a lowly pizza person. Right? So let's say I need to raise money. Well, if I need to raise money, we're going to go the other direction. Well, I can do that in two different ways. First, I can go the debt equity way, and I can issue bonds. Maybe I go to people and I'm like, hey, I'm gonna give out bonds, right? And if you give me $100 for this bond, piece of paper, bond, I'm going to pay you back $103 exactly 1 day from today. Or 1 year from today. So I have this piece of paper, I wait a year, I turn it in, I now have $3 extra. Cool. This is the debt financing. And the bondholders are going to receive these interest payments. This extra bit of money that you've agreed to how much it is beforehand, right? Okay, that's one way. Let's say I didn't really want to go the bonds way because it's expensive to pay people back. I don't want to be involved with that. Maybe I would be cool with some more people kind of contributing to the equity of my Pizza Palace. So maybe I decide that I want to have instead equity financing. I'm going to do this in the form of stocks. Now, there's a lot of other things we can talk about besides stocks, but if you're really interested in that, I know some great finance classes that a certain Department of Economics and Finance can offer you to tell you about this. We're going to do the less in-depth way and talk about just issuing shares. Well, okay, I issue the shares. We now have some new people who are invested in the company. They're in it for the long haul. They really believe in this. They would like to have more locations of this pizza joint. Well, okay, then what are we going to do? Well, sometimes I'm going to make some money and I'm going to pay them out a dividend, keep them happy, give them those little bonus checks every now and then. And then one day they're going to sell their stocks. And the difference that they have in between the money they put in and the money they get out are capital gains that they're going to be receiving. This right here is all of firm investment in one simple flow chart. It's kind of cool. So why do we have a corporate tax? Well, we have a couple reasons for that. First off, we have to think about what profit taxation really looks like. So let's consider what are profits. You've been an economist for a while now. Let's go all the way back to your 112 class where they started off in maybe your first week or two and they talked about two definitions. First was the idea of accounting profits. This is money in, money out. Money in, money out. We have it on a ledger so that we know exactly how much is in bank accounts. Money in, money out. Accounting profit. If revenues are more than costs on paper for things that you physically pay for, you have made an accounting profit. Woohoo! That's not necessarily the same for everything, right? We also have the idea of economic profits. Economic profits are the difference between the firm's revenue and its economic opportunity cost for production, right? I could make $1 million, but if I could have rented out all those same machines for $2 million, I'm not making a good decision. Maybe I could have instead made a lot of money working, and I could have invested all those machines and gotten interest from them, and I could have made wages elsewhere, and I could have had more productive means of this land. I could have sold off this land to someone. Well, these opportunity cost of production, when we're looking at those compared to our revenue, this says something about our economic profits. If firms have market power, they earn pure profits, and a tax on pure profits has distortions, right? This just means, let's not even think about the accounting part. What if we thought about the economic part? Well, some firms sometimes make economic profits, right? When we've determined in the long run, as long as there's competition, they don't, but in the short run, they do. They can make this economic profit. Well, any sort of pure profit they make, any economic profit they really make where their revenues are more than these other pieces, if we tax that, it doesn't really have any distortions because this isn't necessarily having a trade-off in between two different things. You could have done something else. This is the best idea and you're going to make the most money from it and you're making this profit. Cool. This is more than your opportunity cost for production. So if we tax this bit of profit that's really your best option to begin with, well, then you're not going to really change the amount that you do of something. And the distortions here in the form of taxes aren't really as impactful as if you were making poor economic profit decisions. So we have the idea of like what happens on the profit side. Then we have to think about the retained earnings side, right? If corporations were not taxed on their earnings, owners could just avoid taxes forever. So I'm a company, I bring in money. I can pay off some of it to pay off my bonds. I can pay off some of it to my stockholders. I can pay dividends, and then I can have retained earnings. This is money that me as a corporation can put into a bank account to be able to use for, like, yeah, buying some more planes, having in case there's some sort of economic fallout and the apocalypse comes, right? And these are retained earnings that we can have. Well, we need to tax those, right? Because it is kind of income for the company. It's money that they can use for other purposes. If I didn't tax this, then why would I ever write myself a paycheck? I can just leave the money in the business and it doesn't get taxed. Why would I ever pay my stockholders? I could just leave this money in the business and it'd never get taxed. It wouldn't make sense in those situations to, if I didn't have this corporate tax, to do all these other pieces of the equation. So we need to tax retained earnings because this is income for a corporation that they're going to be using to make decisions. These retained earnings, if we didn't tax them, would just earn interest tax-free and would essentially subsidize savings. It would just make it so that it's way cheaper to save for these corporations instead of maybe pay down their equity or pay back on their debts, right? So if corporations paid out those earnings many years later, the present discounted value of a tax burden would be quite low. So what do taxes actually look like? What's the structure of a corporate tax? Okay, and I will probably on your homework give you a very simplistic problem looking at this, and then on your test would also be another simplistic problem looking at this, because I need you to go through the mental parts of how do we put together these corporate taxes. So first we have taxes. What are taxes really equal to? Well, taxes are going to be equal to our revenues minus our expenses. Well, what does that mean? And that's just the first part of the equation. We're going to explain the rest in a minute. But what does that mean? This means that what I'm selling of my goods and services and the money I make from it minus the cash flow cost of doing this business, the interest payments I'm having to pay on the loans, the depreciation allowances that I have on the machines, the wages that I'm going to have to pay. So I subtract those out. So then I have really what this profit looks like when I take away all of these different types of expenses. I'm going to multiply that by tax rates. And then I'm going to minus out any tax credits. It's the same as your personal income, right? Where you have your income, you pay out some things, you have your gross income, you take out your deductions, you have your adjusted gross income, you multiply by tax rates, so then you have your taxes, right? But then after that point, you're going to say, okay, well, I got some tax credits. You're going to minus out those tax credits, then you find out what you really owe at the bottom. Right? It's going through the exact same thing for corporations. Corporations end up making money and they have to less out all the things that they're expending or they have expense on, multiply that by different tax rates. They get to an idea of what they owe. They minus out their tax credits and then they have what they really owe. Now, I did say a word in there that you might have been confused on, and that's going to be depreciation. What is depreciation? Well, in Alicia's Pizza Palace Emporium, we have $40,000 pizza machines. A year from now, I cannot sell off that $40,000 pizza machine for $40,000, right? It's had a year of wear and tear on it. How about a decade later? I bought these $40,000 machines. It's been a decade. How much can I sell it for? Like maybe $2,000? Machines have gotten better. This has had a lot of wear and tear. It's held together by duct tape. Who would pay me $40,000 for that? So there's a rate at which these capital investments lose their value over time. It's the same thing as like depreciation with your car. Right? While your Kelley Blue Book value of your car goes down every single year, it's the same for capital investments within corporations. So they have to deduct that each year. Each year they have to take out some of these expenses for what these depreciation allowances are, that their stuff is just worth less, because that's a sort of cost too. What I mean by depreciation allowances is just kind of the amount of money that a firm can deduct from their taxes to account for capital investment depreciation. If I have a bunch of $40,000 machines and I can only sell it for $30,000 the next year, then I'm going to have to write part of this off of my taxes, because that's kind of like me losing money, because it means that the goods or the pieces of capital that I have aren't worth as much if I needed to liquidate them. So that's part of the equation that we have when we're looking at the structure of corporate taxes. Now we need to think about economic depreciation versus depreciation in practice, right? Because it turns out it's extremely hard to calculate. So we would like to say that we know the true economic depreciation of everything, and I know exactly how much less my pizza ovens are going to be worth next year, but that's not true. I have no idea. I know nothing about pizza ovens besides the fact that they exist. Right? I can't tell you how much they depreciate each year. I can't tell you in 60 days that people are going to pay me exactly $1,432 less of it. I mean, we don't really have that idea. We have rough numbers. We have rough estimates. So with this, we have to try to come up with some sort of way that we can put this into practice, this really difficult thing to measure. One thing we do is we have depreciation schedules. These are timetables in which assets may be depreciated. The $40,000 pizza oven, I think, might have a lifetime of 10 years. Okay, all right, if it has a lifetime of 10 years, that means that I'm going to have a schedule over 10 years. Maybe the first couple of years they lose $2,000 of value. Maybe in the last couple of years they lose $4,000 of value. But each year we have a schedule for how much it's going to lose, right? Then we need to expense some investments, which expensing investments is just deducting the entire cost of an investment from taxes in the year in which the purchase was made. That $40,000 pizza oven, I'm going to have to deduct as a business expense the year I buy it. Then I lose money every year it sits in my store because I can sell it off for less and less. It's not worth as much. So deductions go down over time. Now, you might be wondering, like, okay, you get to write this off? Wouldn't it be nice if my $40,000 pizza oven was worth only $1,000 a year later? Because then I could write a lot off in taxes. Like, that could save me a ton of money. Deductions claimed sooner, when things depreciate a little bit faster and sooner, these are more valuable than thinking about, okay, well, what about that $1,000 I'm going to lose in depreciation 15 years from now? Because guess what? I might have replaced those pizza ovens in 15 years. Deductions claimed sooner are actually way more valuable to me on my taxes. So what's really the incidence of this corporate taxation? Is the burden of the corporate taxation really on the corporations themselves, or is it going to be shared? Well, it turns out the burden of corporate tax is shared in some proportion by consumers. Maybe they might have higher prices. Maybe the quality and safety might be affected. It's going to be borne partially by workers. Are we going to pay the workers less, or are we going to pay the workers more? If I have a really hefty tax bill, I might not be paying the workers as much, right? Corporate investors. If I'm having to pay a lot in taxes, I'm probably not paying as high of payouts to my investors, or I'm not maybe buying them as much swag at the corporate meetings, right? Non-corporate investors, my bondholders, well, I'm not paying them back off early if I have big tax bills. The burden of corporate taxes are shared in proportion by lots of different people or lots of different groups, and that's because a lot of this does get passed through into other means. So we're not necessarily looking at the partial equilibrium effect. We're not looking at just like, oh, taxes go up, taxes go down. Do I make more or less pizza? We're caring more about the general equilibrium. Do I hire more or less workers? Do more people want to invest in here? If they do invest in here, what do the rest of their investments look like? There's something that's going on with the bonds. Are they more or less likely to invest with me? Are they going to need higher interest rates if they know that I'm having these sort of tax payments? So we have general equilibrium effects through this capital movement through the corporate and non-corporate sectors alike. So it turns out, and if you want to talk more about this, feel free to email me because I love talking about it, but a lot of the recent literature kind of suggests that corporate taxes, the thing that's hurt the most or influenced the most is actually wages. If you have really high corporate taxes, people get paid less. So that's pretty interesting. There's a very large effect that's persisting there that we need to know how to understand. So what does this mean for your individual investments? Well, not necessarily for your individual investments, but investments into this company. Well, with no corporate taxation, the investment decision is determined by firms setting the marginal benefit and cost of investment equal to per period basis. That makes sense. That means that every single time I'm making a decision, if I can assume that there's no corporate taxes, I'm going to look at the marginal benefit of something. I'm going to look at my marginal cost of something. I'm going to produce where that marginal benefit is equal to that marginal cost. We've learned that for years in economics. But when I'm estimating the return I'm going to be getting from investment in each period, I have to compare the cost of investments in each period. Is this going to cost me an additional 3% in that period 4 periods from now? Is a year from now, am I going to have to make a bigger payout on this debt or this equity? And I'm only going to invest in something or invest in a company if I think the money that I can get out of it is going to be more than what I'm putting into it. So I got to know what else is going on with this company. So let's look at it like this. Let's say that we have a flat marginal cost line, right? This delta essentially just means depreciation, and then we have some other fixed costs. So there's some sort of marginal cost in each period, and it's relatively flat. We're going to say it's flat because most perfectly competitive firms have flat marginal cost lines. Going back to ECON 112, we're going to have this flat marginal cost right here. But marginal benefit for each investment dollar is probably going to go down, right? So as we have this quantity of investment, well, when you give me my $100 to start my pizza kitchen, that $100 is going to help a lot. If you give me $1 billion for Alicia's Pizza Emporium in Edwardsville that probably doesn't cost all that much to run, well, there's not going to be as much of a benefit from that last investment dollar, right? That's not going to make or break my pizza palace at that point. So if we have no corporate tax in this world, because see, at this world we just have this marginal cost equal to marginal benefit, we're going to choose to invest here. We're going to call this K1 at some level of investment right here. This is where we'd be. Super easy. Marginal benefit equals marginal cost. The marginal benefit is equal to the actual return per dollar of investment. Every amount of money that I think I'm going to get back for $1 in, it's about how much we're going to be willing to put in for the cost aspect of it, right? Well, what happens when we introduce corporate taxes? Well, with corporate taxes, firms invest less because government takes some of their returns, right? Let's say that I'm a corporation. I need to figure out what I'm going to be doing with my money and what I'm going to be deciding to invest in. Do I want to buy a new pizza oven? Do I want to buy 12 new pizza ovens? Well, that depends. How big's my tax bill this year? Firms invest less when there's tax bills because government's going to take part of my returns, right? I could have made $1 million, and with $1 million, I could buy like 12 pizza ovens. But if I'm having to pay $200,000 to the government, so I really only have $800,000, I might not be buying those same 12 pizza ovens, right? The firm's after-tax rate of return on investment needs to be large enough to meet the required rate of return. Let's say I'm making $1 million in my pizza palace, and I really need to buy some $40,000 pizza ovens. I'm making $1 million. If I'm taxed at 20%, okay, I got $800,000. I might still invest in some of these pizzas. If I'm taxed at 90%, oof, I don't have a lot of money left. I can't afford any of the pizza ovens. Maybe I'm not going to do that at all. Maybe I might just close up shop. Maybe I might decide to make something else because I'm not meeting my required rate of return to be able to keep up my business, right? So we're going to want to be somewhere in between those levels. So as a result, pre-tax rate of returns must be higher than it is without taxation. And that only occurs by investing less. And it's kind of a cyclical relationship. What do I mean by this? Let's look at it on a graph. Right? So maybe originally we were going to operate at A. Well, we've shown taxes on a graph before. We have our marginal cost, we have our marginal benefit. Let's say that we're going to put a tax on the benefits of this investment. So all the money that I'm getting back from this investments I'm making, we're buying the 4th or 5th pizza oven, and then the money I'm making from my sale of pizzas, I'm going to have some taxes on that. There's going to be effect of this taxes, right? It's going to drive, I actually don't know which way the camera goes when you see it, but assume that I'm following A to B. It's going to drive down that marginal benefit so that the essentially marginal production from capital, the extra bit that we can make from one more machine, well, that's going to have to be times 1 minus the tax rate. We're going to have to take away the taxes from this situation. Okay, if we have taxes, we've shifted in our marginal benefit. Because if I'm paying taxes, I'm not getting as much benefit from each additional dollar. Well, in that situation, I'd move from A, where my marginal cost equals my marginal benefit, to B, where my marginal cost equals my marginal benefit. Because the cost is still going to be the same. We're still going to have depreciation. We're still going to have things that we need to do. But what does that mean for our quantity of investment? Well, that means we reduce our investment. We decide not to invest as much into Alicia's Pizza Palace because we're getting taxed on it. Okay, well, what do we do in that situation? Well, if maybe we have some sort of depreciation allowance on these pizza ovens, because they would still like me to buy pizza ovens, because if I have pizza ovens, then I produce pizza, and it might be delicious pizza. Who knows? I could be a great chef. I doubt it. I highly doubt it, but it could happen. Okay, so let's say that it's been a year. These $40,000 pizza ovens are now worth $30,000. Okay, well, if I can instead shift this marginal cost downwards, because now I'm removing some of this depreciation allowance at this point, my marginal cost is reducing, because these pizza ovens, I can write off part of them because they're not worth as much to me. I can't just go out and sell my pizza oven that I paid for $40,000 for $40,000 a year later. I'm gonna have to drop the price, right? So once we reduce out some of this depreciation, well, then where do we hit on this marginal benefit line after taxes? Well, at first we went from A to B, but if we add in depreciation allowances and people are allowed to write some of this off, we start to shift some of that quantity of investment dollars back out. We might get to C. Well, that's pretty cool, because in this point right here, depreciation allowances have actually encouraged some of this investment to come back. It could be that because you're putting taxes on me, I wasn't going to buy any pizza ovens. But now that I can write off what I'm losing on the old pizza ovens, my tax bill's less expensive. Okay, if my tax bill's less expensive, maybe I will actually buy a couple of those pizza ovens anyways. I might increase my capital investment. Is it going to be by the same amount as the original tax bill, like reduce me? Maybe not. It depends. It's a very case-by-case situation. But at least the loss to the quantity of investment dollars is reduced in those situations. So there's a lot of policy implications from this, right? Because you're probably thinking like, wow, well, why don't we just depreciate everything? Or do we really need corporate taxes? Because now people aren't investing in capital. By the way, whenever you see ITC, I just mean kind of like an income tax credit, right? Because we're allowing like deductions or for them to be able to write off essentially tax credits later on in different situations. But if we had a tax on just the revenue of the firm with no deductions, no tax credits, we're going to reduce our investment, right? And we're going to induce our investment by kind of reducing the marginal product of this capital. How much I'm really going to get out of each pizza oven, how many pizza ovens I'm really going to buy, things like that, right? So deductions and tax credits don't undo this effect. They don't completely make us reinvest all this capital. The 12 pizza machines I would have bought with no taxes, and then I got taxed really bad, so then I was only going to buy 2 pizza machines, but then I got to write off some of the depreciation so that maybe some of this money I'm actually losing in real value gets taken care of. Maybe instead I decided to buy 4. Well, we've gone from 2 to 4. That's not as much as the 12 as I originally would have bought, right? So it's not going to completely undo the effect of taxes. But a big enough deduction or credit can really encourage investment, sometimes to before pre-tax levels. So I don't know, that's kind of neat, right? But like, that's just an interesting thing to think about. Now, we're talking about Alicia's Pizza Palace in Edwardsville, Illinois, right? If that did exist. I can't see anybody giving me a business license. But what would we do if this was instead an international corporation? What if I wanted to operate in multiple places, like Edwardsville, and then a small town in maybe Toledo, Spain, because I went there last year. It's actually pretty cool. Toledo, Spain, and then Buenos Aires, and then Johannesburg in South Africa. Let's say that I'm going to be a multinational firm. Well, okay, cool. What are those taxes going to look like? That's going to be a mess. If I have locations in 4 different countries, how on earth am I going to figure out my tax bill? We're going to figure that out today, right? So first, let's think about subsidiaries. Subsidiaries are kind of the production arm of a corporation, right? If I have a pizza place making pizzas in Johannesburg in South Africa, that's a subsidiary. They're doing their stuff over there. Okay, Toledo, Spain. There's a subsidiary there, making the pizza. They're doing the pizza real good, right? Buenos Aires, same thing over there. These are kind of production pieces of my corporation that are located in other nations. Now, international operations can actually provide a lot of tax breaks. Why does Facebook operate in Ireland? Because there's tax breaks associated with it, right? Also, a lot of data protection stuff. Kind of. Anyways, for example, GE, so General Electric, right? They've made some cars, they've made some engines, they've made some medical MRI machines and different sort of imaging stuff. GE, they claimed a $3.2 billion US tax break on a $14.2 billion of global profits. 5.1 billion was made in the United States, thanks kind of through international diversification, right? Because they were allowed to have different sort of subsidies in different areas. But what happens if they're taxed in another country, right? How are we going to tax international income? And this is important because not only are they paying national taxes, they're paying state taxes. And when I'm allowing Amazon into my state, assuming that I had any sort of situation like that, I'd have to think, okay, how much of their money are they going to make here? How much are they going to make in other countries? Like, they're located here, but how much is really going to come to me? Right? Or to this system. So what I mentioned earlier is that we had moved to a territorial tax system. That's because in the United States, previous to 2017, we'd kind of been more on a global tax system. And these are systems in which corporations are taxed by their home country on income regardless of where it's earned, right? This is the reason why we would have telephone answering services in India instead of India having telephone answering services here. Right? A lot of that was because you were taxed by kind of essentially home countries regardless of where income is earned. So if I had been operating this in Dubai and I had made money there, it would have been taxed at US tax rates, even if Dubai has a significantly lower tax rate. So what we ended up switching to was a territorial tax system. Because notice in that global tax system, why would I ever bring my money back from Dubai if I knew that I was going to be paying a really high corporate income tax as soon as I did? Might not want to. But in a territorial tax system, these are tax systems in which corporations and their earnings, their income earnings abroad, pay taxes only to the government of the country in which the income is earned. Okay, that means if I have a subsidiary in Johannesburg, they pay the taxes of Johannesburg. If I have a subsidiary in Dubai, I have some stores over there, and they make profit, they're only going to pay the taxes from Dubai. And then I'm going to pay the ones in the United States, because in Edwardsville, that happens to be located in the United States. I know, shocking, right? So territorial tax systems mean that the firms might face different tax rates, or many different tax rates. But is them facing many tax rates actually easier? Then they had to come in and they had to pay US taxes on every single bit of those profits, and they had to go back to these other countries who were trying to tax them because they were already on a territorial system. Most of the world's been on it for a while, and then they try to tax them, and then they'd be like, but hold on, I already paid those people taxes. Then you have to figure out who owes what, and there's reparations for it, and it was a little bit of a mess. Territorial systems just kind of essentially mean, okay, you made profit in X country, you get taxed at X country's tax rate. So much easier. So okay, little bells and whistles should be going off in your head being like, wow, hold on, then why would you ever take your income to really expensive places? Hold on, is there some sort of like issue with that? Maybe with people not necessarily transferring everything the way they probably should. So the fundamental problem tax authorities face in taxing foreign income is that when a good is purchased using inputs from many nations, how do you figure out where the profits are really earned from? Okay, let me give you an example. Samsung, right? I have a Samsung phone. Pretty cool. I like it. S10, it's shiny, it does all the stuff, it has the bells, all the whistles. This was not all made in one country, right? There might be a microprocessor from France. There might be a speaker that came from Brazil. I am not a representative of Samsung, and I have no idea where the different pieces of this phone went, so please don't quote me on where any of these things are. I'm just making examples. The glass could have come from Mars. I don't know. I really don't know that. So now, at the end of the day, when we sell this phone, and they sell it to me for an unreasonable price, if I do say so myself, when they sell it to me for an unreasonable price, and I give them that money, they now have this profit. How much of this profit, what percentage of this phone was the glass made on Mars? What percentage of the profit I get from this phone is from the microprocessor from France? How do I give all the profit from this phone to the respective countries based upon what's in it? Because how can I say, okay, $850, like definitely $22 of that is profit from people willing to pay for the glass. If it was a different glass company, they might not have. And okay, so this much is going to be paid for the speaker system. So we're going to get that much. That's complicated. It is very, very difficult to appropriately attribute profits earned to any particular nation, especially when there's multiple nations going into making one good or service, right? So then we have to think about transfer prices. Well, transfer prices, this is just the amount that one subsidiary of a corporation reimburses to another subsidiary of the same corporation for goods that are transferred between the two. Let's say let's say Mars is a country. It's not, but let's say Mars is a country. Mars sells me the glass for the Samsung phone. I make $850. Okay, then I'm gonna need to transfer back some of this money to Mars, right? Because they made the glass. Part of this profit is theirs. So I need to give it back to my subsidiary there. But what would my first question be? Okay, Mars, I know you're located in Mars. We're paying 21% taxes here. How much are y'all paying? 52? Oof. We're going to say not much money came from your piece. Your piece didn't make a lot of money. We're going to give you like $100,000, and the rest is over here where we're taxed a lower amount. Firms end up shifting their profit to low tax countries in these situations by setting high transfer prices for goods produced in those countries. So that essentially means, okay, let's say that I'm making $22 from the glass from Mars. Then I'll be like, okay, Mars, sell me this glass for like really high price. Like we're gonna have a lot of shipping price and stuff like that, so that I can say like not a lot of profit came from you because you cost me some money. Not a lot of profit came from you. So instead the profit stays here where I can get taxed at a lower amount. All right, so let's give you an example besides my ridiculous Mars example, because I am not good at examples. Let's imagine that France, right? Let's say that France levies a 40% corporate tax on corporate profits. That's a lot. We're right now at 21% with those 2017 changes, right? So taxes here, corporate income taxes here, 21%, corporate income taxes there, 40%. Oof. That's a bit of a difference when we're talking about billions and billions and billions of dollars. So let's say that there's a US company making computers. And let's say that we have a French subsidiary that manufactures the microchip. So me, the really cool, like super awesome computer buildy person, also has this French company that we have a lot of ownership in and stuff like that. They're part of the same company. They make our microchips in France. It costs $100. Okay, all right. Each microchip, when it comes to the United States, is added to $500 worth of other computer parts because computers are expensive, right? So we add that microchip to this other $500 worth of parts. We have the super cool computer, and I sell this computer for $1,000. $100 microchip, $500 of parts, $600 of cost, $600 of cost relative to $1,000 of money people pay for it. That's a $400 profit. Well, how much of that profit is attributed to the microchip? If I say that all the $400 in profit came from the microchip because people are buying this super cool computer for the microchip, well, then I'm going to have to pay that $400 to France, where it's going to be taxed at a rate of 40%, which means $160 is going to go to the French government, and my company afterwards has $340. Okay. What if instead, me as the company says that none of the profit came from the microchip? Psh, no one cares about microchips. They totally bought this $1,000 computer for the cool fan that I put in it. Not the microchip, the fan. And that's US based. So we're going to have all that profit here, right? So we're going to pay France nothing. And instead I'm going to get taxed on this entire $400 in the United States at a rate of 21%. Well, if I'm getting taxed at a rate of 21%, that means I'm paying $84 in taxes to the US government. If I said that the profit came from France, I'd pay $160. If I said the profit came from the United States pieces of this computer, then it's cost me $84. I saved $76 by saying that profit didn't come from the microchip. From that, you're probably like, okay, but are people really that dishonest? Let's go through the ABCs of avoidance, right? As long as there have been taxes, there have been people who have attempted to avoid their taxes. Let me give you a couple examples. ABC. A, Apple, right? So by relying on low corporate taxation in Ireland, Facebook does this too in Ireland, by the way, and a creative organizational structure, Apple shifts a lot of its profits to Ireland. Ireland has had a very special relationship with Apple for a long time, with single-digit tax rates that have been persisting for years. So any money that they technically make in Ireland or due to Ireland pieces is taxed at a very, very low rate. That's an avoidance behavior strategy. Let's B, Burger King. All right, Burger King has a corporate inversion. This just means that they work really hand in hand with a lot of companies in Canada. Right? They essentially almost look like they're based in Canada, even though they're not on paper, because they've had a lot of this sort of profit relationship with them. It's estimated that Burger King will avoid anywhere between $400 million and $1.2 billion in U.S. taxes over the next 4 years, purely because of how it can say that a lot of its pieces and profits come from Canada. Okay, A, B, C, Caterpillar. In 1999, Caterpillar decided that the company could sharply reduce the American tax on profits from the sale of parts sent to the United States to customers around the world by simply taking the name off invoices and replacing it with a Swiss subsidy. They didn't even try to say, okay, no, we didn't make a lot of the profits from there. They just took their name off the receipts, put their Swiss company on the receipts, and then all of a sudden they had a lower tax bill. So as long as taxes have been around, people have attempted to avoid them. Let's have another extra credit. So remember, you get 5 extra credits in this class. We've only done 3. We only have 2 weeks left of the semester, so I need to give you another extra credit. Let's go to student preview mode. Boom! Super awesome public sector course. Let's go to discussion boards right here. There is extra credit 3, which I gave you a couple weeks to do. If you go back and still do it, I'll still give you credit. All right, let's have an extra credit number 4. We're going to call this the ABCs of tax avoidance. So if you go in there and you create a thread, I already gave you A, B, and C, right? I already gave you examples for those for tax avoidance. Give me some other letter of the alphabet so that I can hopefully put all this together. So pick your favorite letter of the alphabet that's not A, B, or C, or F, because I already used Facebook as a situation. And give me an avoidance story or situation, just a 1-paragraph story or situation that's similar to this, where we show avoidance of some sort of country or of some sort of company by working with foreign subsidies. It's an interesting thought experiment, and you might learn some cool stuff. Go put one up there on extra credit. What is it? Extra credit number 4. If you do that before, what's today's date? If you do that before May 3rd, I'll give you an extra point on your final grade. Cool. That's counted as your in-class extra credit because honestly, it helps keep you involved and paying attention to the videos. So we have our ABCs of avoidance. Go do that. Go get your extra credit. So we've talked a lot about equity and a lot about debt, but what really happens when we have different earnings, right? Let's say that me, as Alicia's Pizza Palace, earns $1. What am I going to do with that $1? Well, if I earn $1, taxation as earnings is going to be passed to the firm in one way or another. If I pay income to bondholders, then I just take that $1 and I pay the $1 to bondholders. Well, then those bondholders, they get this $1 and they're like, oh, cool, $1. And then they have to pay taxes on it. One taxes have been taken out on that $1. Let's go the other way. Instead of paying my bondholders, let's say that I want to pay on and distribute after-tax income. So I've made this money as in Alicia Pizza Palace, and I have this $1. I'm going to pay taxes on this $1. So we've already had 1 tax taken out. Then I'm going to give it to the stockholders. If I pay it to the stockholders as a dividend, then not only were taxes taken out when I made this money, but when I give it to the stockholders, they're going to have to pay a dividend tax twice. Let's say that I instead say, oh no, okay, maybe I'll do it on capital gains. Maybe I'll try to raise the price of the stock, not necessarily give dividends. Okay, so I had this $1 come in. I paid taxes on it, 1 tax, and then I give it to people in raised prices on the stocks, and they're going to get capital gains. Okay, and then they sell off the stocks, and then they pay a tax on the capital gains. 1 tax, 2 tax, 2 tax. So that means that income that comes in that I pay to stockholders, each one of those dollars is essentially taxed twice. Well, if I send it to the bondholders, they're only taxed once. Well, in that case, why would I ever use equity? Why don't I just like only have debt? Because it's taxed, there's a huge tax advantage. It's not a double taxed $1, it's only taxed once. Why do I use equity at all? Well, that's because of kind of the structure of what debt relationships look like, right? Bondholders only get paid if the firm doesn't bankrupt. If I only have debt, I only take out loan after loan after loan after loan after loan, my chances of not going bankrupt goes down, right? If I keep taking out loans, what are the chances that I can keep up the payments for all those loans? How does that compare to instead having a bunch of people who really believed in my company, who said, hey, here's some money. We believe in you. Here's money to operate with, and we're going to get it back later, but not on a set schedule. Well, let's say there's a firm. Yes, Kat, please sit down so I can read the screen. Okay, let's say a firm earns $600,000 per year and I have a 10% cost of debt, right? So each year, okay, I'm going to have to pay about 10% of my money on debt, paying off these loans. So now I have to consider a project with a 50-50 chance of I can earn $3 million or I can lose $6 million. So if I lose $6 million, I'm going bankrupt. I don't have to pay for this 10% debt anymore. Yeah, okay, hold on. I'm a debt-heavy firm. I don't like making these payments. Let's go ahead and we're gonna take that chance, even though there's a 50-50% chance of like losing a bunch of money. That's not what bondholders want to hear. That's not what stockholders would want to hear either. But if I have loans, I don't necessarily have to listen to every single person holding one of my loans. If I have equity and I'm sharing off and I'm selling off partial ownership of my firms, well, then I do have to listen to my shareholders and try to work in their best interest. For example, let's say that we had some sort of situation where we were wanting to have different shares of financing, and we were thinking about this gain that we could have from this investment and loss to the investment and returns. Well, my equity holders that had small portions of financing could have a really big gain or really small loss that's less than that. Well, they would want to take the risk, but would debt holders want to take this risk? Well, if they gain any money, I'm a debt holder. I get paid back my exact percentage rate of return. So no matter what, I'm making back the same amount of money. There's a huge amount that I could lose because it could get to the point where they don't pay me back. And I'm not really going to gain anything. I don't want them to take this project. Big equity holders might not want them to take this project. Debt holders don't want them to take this project, but some equity holders might. The decisions that equity holders would want a company to make versus what debt holders would want them to make are completely different. And the chances of bankruptcy is scary. So that some debt holders might say, okay, well, if you're a very debt-heavy company and you don't necessarily have equity that's financed through individuals that believe in this company, instead you're all loans, we might be less likely to give you a loan in the next period. So corporate taxes is an important determinant of the behavior of firms. What state they locate in, what town do they locate in, how much are they going to pay workers, how much of their money are they going to say they made overseas, right? It influences decisions on investments and financing, whether I'm going to be equity or debt, or if I'm going to retain my earnings, or if I'm going to give dividends, or am I going to push the stock price up and allow people to have capital gains. Those are all decisions that they're going to make. They're significantly influenced by the tax environment in which these things have existed in. Now, the United States has faced a difficult set of decisions about how to reform its corporate tax system. We constantly try to make changes. Sometimes there's cuts, sometimes there's raises. And at the end of the day, little action, despite repeated calls for reforms, have actually been done. Like, there's big changes every few decades, but we don't have a system that's keeping up with how the world paces itself. So this is something interesting to think about moving forward. Okay, what do we remember? What do we remember from today? Today was a long day. We remember that final draft due on April 26th. Get those to me. This cat is adorable. I don't know. That's something really important to remember because she's a wonderful cat. Okay, final draft. Final exam on May 4th. You'll have all day to do it. Has to be done by midnight. Has to be done in one sitting. Okay, I think that's about it. Go do your extra credit 4. Have a great one. Bye.